My name's Ollie Stone. I'm the investment director at Fairstone. So I head up the portfolio management team and the operations team.
Harry Scargill, portfolio manager.
Yeah, hi, I'm Stanley. I'm the head of product at Fairstone.
So yeah, important to say, first of all, that every investment carries a level of risk. But generally speaking, in theory, the more risk you're willing to take on, the higher your potential return will be over the long term. But equally important to say that risk is a very personal thing. So an investment that might look or be perceived by one client and one investor as low risk may be perceived by the next as high risk. And that's dependent on your financial situation, your mindset, your attitude to risk, and so on. So your Fairstone advisor will work very closely with you to ascertain your risk tolerance, so how much risk you're willing to take and able to take. And they'll find a portfolio that best suits that risk profile that you have.
If you're sitting there thinking, you know what, I know what I'm putting in, I'm happy to get out with a degree of certainty what I'm going to get out, and that's going to deliver my outcome. For a certain personality type or character type, that's exactly fits the bill. But for another person, it wouldn't. So it's not the case that these are better or worse. These just fit personalities, circumstances, objectives better. And we describe those in terms of risk weightings. The asset allocation you'll be put into will be defined largely through that process of discussion with your advisor. And that will be based on what's your objective, what's your time horizon, what's your attitude to risk, how much money can you afford to put in risk, could you lose, what kind of level of losses could you bear. And that won't always be the same. So for example, someone starting their investment journey in their 20s or 30s may well want to take more risk than someone who's approaching retirement is beginning to think about how they, tighten up that nest egg and think about those things they want to do in the future. And the asset allocation allows the manager to deliver that, for example, by increasing the weight of equities in that riskier, more acquisitive, earlier stage, and then thinking about how we use fixed income, bonds, and even cash later on to think about where we're focusing more about certainty and security rather than growth.
Defaqto is a risk scoring system, so they will look at all the different asset classes that we might be investing in and sort of score them based on the volatility that they bring to the portfolio. So what we then try to do is blend these different assets into a way that matches the end client's risk level. So Defaqto has risk levels, so we manage risk levels 3 to 9, going up in the risk scale, so typically more equities as you go up that risk scale. And yeah, we use Defaqto to make sure that we're adhering to those risk tolerances and the volatility that the clients can come to expect.